out of Miami, and Gary Post, who I like to think of as the godfather of Southern California private equity investing for the family office space. So Gary's ex-Drexel and worked at McKinsey, and then has managed a variety of private equity funds over the years. So Shelley O'Donovan will be our erstwhile moderator. And Shelley, take it away.
Excellent. So I just want to welcome everyone to our panel this afternoon on private equity. My name's Shelley O'Donovan. I teach at the Wharton School. I also have my own business called the Authentic Influence Group. We go into businesses and help folks with all sorts of different relationship type things, help people to make decisions in their businesses that influence as well. So with that, you can track me down if you want to learn more, but with that, I'm excited to have our panel today. So I'm going to jump right in because Marty gave a little bit of an introduction of each of you, but I will start with you and ask you if you can give us an introduction and then pass the torch there.
Hey, thank you. I'm Gary Post. I'm the managing partner at the K-Funds. We're based in Los Angeles, and we get in the middle between venture capital and buyouts. And what we're looking for is companies that use information to do things dramatically different. We're equity investors. We don't use debt, and we're excited to be part of history.
Thanks. Hi, Mike Magliacetti. I'm an operating partner with Riverside Partners in Boston. We're a lower middle market private equity firm. I've been with the firm for about 13 years. Didn't grow up in private equity. My background is a bit different. Originally trained as a chemical engineer, and after a PhD in chemical engineering and business school, focused more on general management. And over 22 years before joining Riverside, I had the good fortune to run 3 companies in the healthcare space through sale transactions. My last was a company called CROs, and during my tenure at CROs, I was an advisor to Riverside for about 4 years. And after that transaction, I made the jump. So glad to be here. Thanks.
Good afternoon, everyone. My name's Sammy Dweck. So born in the UK, spent most of my career in finance, 26 years, 19 of them with JP Morgan, building out emerging markets businesses. Retired in 2019. I now work with a single family office where I sit on the investment committee. And for that one single family office, we're overseeing about 2 billion of assets that we allocate, amongst other things, to alternatives.
Yeah, excellent. Well, I'm excited to have you because on our calls leading up to this panel, it was clear that you all come at this from a little bit of a different perspective. So with that, my first question is just what you currently think is on the minds of folks in private equity, and what trends are you seeing emerging in each of the areas that you might cover? So Sammy, let's start with you on the end, and then we'll run back down the other way.
So when I look at the family office space, and I'm looking at myself as a family office, looking outwards, it's funny, there was an article that came out this morning on Bloomberg by Devin Pendleton about Goldman Sachs' report saying family offices are allocating less to private equity, which I find that surprising. And there was a panel earlier saying that endowments are reducing. I think it's, as an investor, we're looking for returns. We're looking for the opportunities. And vintage by vintage, so year by year, you're looking at what is the opportunity set and do I find things that fit my criteria? So I would say from our perspective, the things we've been looking at over the last 6 to 12 months is defense, infrastructure, which may be AI related. And more recently, we've been looking at media and sports. So those have been kind of top of mind for us.
Excellent. Mike?
Yeah, you know, for us, just a little bit of a backdrop, we focus 100% on founder majority management owned companies. These are good companies. They'd be good companies whether or not they met us. They're at a point where, you know, the founders may have a couple of decades of sweat equity into the business, a good deal of their net worth concentrated in the company, and want to take some liquidity. And so, you know, for us, there's just a tremendous amount of discipline that's really ratcheted up on how we can plug in and add value. Maybe we can talk about that a little bit later. But what I'm seeing is not only that the premium A assets in my sliver of the world that are coming to market are still trading for high valuations. It's the B assets, the ones that have hair on them, that are either not getting done or getting done with a good deal of structure. And another thing I'm also seeing, and we were one of the first actually that I knew of in our sector, is the continuation funds. Back in 2021, we did a $530 million continuation fund off of our fifth fund. Seeing that sort of as a third leg of a stool now for liquidity for LPs. So that's something that has really become front and center in the space.
We're looking at a little different space. We're looking for companies that can dramatically change how things are done. And we're looking for companies that have maybe $5 to $10 million in revenue, but they have a proven business plan and product market fit. And we're trying to grab on to some companies that aren't quite household names yet, but we think they will be. So some of the ones we've looked at, we've been in FanDuel, we were in SpaceX 8 years ago when there were no satellites up. We thought it was going to be the best communications company in the world. Wasn't a household name. A lot of people didn't even understand the SpaceX strategy at that time. The notoriety of artificial intelligence causes a little bit of shift in how we look at things, as we don't want to get left out. And artificial intelligence and a next phase of what AI is going to do, based upon some of the large language models we all know about, is vertical applications of artificial intelligence. Now, there's going to be a lot of confusion and hard to find these, because a lot of what people say is artificial intelligence is actually human intelligence expressed in terms of complicated, detailed algorithms. The algorithms are not artificial. They're created by humans. So one of the challenges we face ahead is not being left out in AI applications, at the same time, not inadvertently invest in algorithms that some human people developed.
Excellent. And what I hear you kind of teasing on, or my second question for y'all, is just how might we be seeing things starting to change a little bit and done a little differently in the past? So I think, Mike, you mentioned this continuation of funds coming back around. What other things are you all seeing, and what does that look like?
We're seeing a great amount of second, third, sometimes fourth companies started up. So what we had maybe 15, 20 years ago in terms of a pool of skilled management and finance people have accelerated a lot. There's a lot more. That means in growth capital, there's likely to be many more successful companies. And that's a change from we go back 20 years and we were looking at first-time founders. We're not looking at that most of the time now. Lots of capital available, and people are trying to catch on like we did. We caught on to CoreWeave a couple of years ago, and hardly anyone knew what CoreWeave did, and it went public. Still, nobody knew what it did, but it proved out something related to artificial intelligence, and that's kind of how we look at things.
Excellent. Anybody else want to jump in?
Yeah, I mean, the outlook going forwards, where the opportunity sets are. I heard things earlier about, lots of different unicorns and going for the next unicorns, but you don't know who the unicorn is until they're a unicorn. And so trying to spot the unicorn is very hard. So I don't believe in that. We're looking for returns. And so where is there space for returns, and where do I have fear in the markets? So I think everyone started chasing in the debt space kind of private lending, which that concerns us, so we're staying away. Infrastructure is interesting, but everyone's chasing the AI story. So which part of infrastructure do you play? And you need to be very selective. So people are chasing data centers, some is energy, so is that utilities. Defense for us is something that's really interesting. Trump kind of kicked the ass of Europe, and I'm saying this as a European, where we were not doing our job as Europeans, paying for the defense we should do, that Russia was allowed to come to our doorpost, and we go, oh my God, what's going on? So defense is a space which is going to grow very much in Europe, but I think the US equally so. So that's a very interesting space. There's a whole change in media. I mean, the media we grew up with is very different today because most of it is streaming. You've seen YouTube become a TV station like a Netflix. So media is another place of change. And with that, the sports, everything around sports with media has changed. Look at the WNBA, how that's changed things and how viewership is changing. So these are opportunity sets that I think you need to be selective when you're looking at the managers that are going after it. I'm very fearful of the mega funds, right? I like niche and boutique. I think that's more interesting. So playing in middle market is really cool. And so I think those are the kinds of things that we need to look at. And I do think that AI, especially for the family office, becomes interesting because when you've got a small setup of 3-4 people doing all the investments, and you've got to do your due diligence, now you can use an AI tool to go and read the documents and give you a synopsis, rather than getting lots of interns to go do that for you, which costs money, and you hope they get everything, whereas AI is going to do a much better job. So I think there's some efficiencies coming for family offices that didn't pre-exist.
And you know, for us in the lower middle market in our sector, we like to say we sell picks and shovels to the gold miners. We're really focused on in healthcare, you know, pharmaceutical services, contract manufacturing, clinical research organizations, bio-analytical testing labs, lab services, and you know, tech-enabled healthcare services. And where, you know, it's not binary for us, you know, and we can our portfolio company clients include the big household names, but also the venture-backed startups in the sector.
Excellent. So you're all coming from different areas, really, of private equity from different angles. So GPs, LPs, single family offices, syndicates, how much does each of your perspective influence how you look for investments?
Well, I think there's a lot of similarities, rather differences. For example, all of our investors are family offices. So we're looking to provide them a private market experience. If we're representing just one family or representing 30 families, we would look at some of the same things. So we're also, again, in this middle growth capital stage, we're looking for innovation. And that's substantially different than my colleagues to the left of me, and I'll pass the baton to them.
Great. Excellent.
Yeah, these companies, you know, for us, there's 3 things really that I focus on is the management. Very often, as I said, these are founder-run companies. In the 36 years my firm has been around, we've never made an investment where the founder hasn't stayed involved with the company in some way, shape, or form and rolled equity in the business going forward. So being intimately aligned with the founder on strategy, growth strategy going forward is super important. The sustainability of the business, and then the growth prospects, whether it's organic or inorganic, are key for us. And the fact that, you know, is it differentiated? Do you have a right to win with the service or product is key.
Excellent.
I think it depends on the type of family office. There are those families who still have their ongoing business, which is going to be the majority of their assets. And so therefore they're focused. So in the case of our family, real estate, right? And that's kind of a core holding. So in our investment portfolio, nothing real estate, right? No matter if Blackstone and BlackRock could come with the best real estate fund in the world, we're not going to touch it because we're heavy real estate. Then you've got the guys who are totally out of the business. The founders have sold and they're just managing a portfolio. It's a very different outlook. So if you've got an asset base that's generating income, that's kicking off, then the investment side is more for the future generations. You know, you're leaving that main portfolio to go where it's going. So when we look at how we're building the portfolio, we're very selective. Because of size, we have access. So I can pick up the phone and speak to any of the general partners at Apollo or CVC or KKR or any of that lot. We're doing our direct due diligence. We're not doing it through the banks. It's nice to go and talk to the banks and see what they have to say, but we don't need to be reliant on the banks. And my background, having come from the finance world, is very helpful, right? Because if I was someone who didn't have the financial background, I think it would be a much more complicated process to be able to analyze, is this a good opportunity? Is this the right time? Are we making the right decisions?
And one thing to add, though, it is a viable strategy for a family to basically double down on their skill set. If it's a distribution family, maybe they've sold all or most of it. Well, they'll go back in and say, well, we can acquire this small distribution company. We can help them. We can, and indeed, they're a leg up on maybe leveraged buyout firms, private equity firms who are looking at the same company, but don't have that experience of leadership in that industry. Perfectly viable strategy. Is it diversified? Not what I would recommend. However, it's been a very successful strategy for some families.
So I have a question for you guys. So this article from Devin Pendleton, which you have to read, Goldman Sachs is coming out saying that regular equities is more interesting from a return perspective than private equity, which I happen to disagree with. Because private equity, by the fact that I'm giving up liquidity, I should be getting at least 1,500 basis points over equities at the very least. Otherwise, it's not worth it. So I'm looking for 2, 3, 4x. So do you agree with the fact that equities, liquid equities, are more interesting than private equity?
No, I think where we are is really the exciting part. We're seeing the FanDuel people really know about it. You know, we're in Chewy before it gets acquired, and that's the exciting part of what we do. And by the time they're public, yeah, okay, Core, yeah, okay, we've seen that before. That's not very exciting. But I would like to make a point, doubling up on what you were saying, is if you're in private equity, you're building a private equity portfolio, you have to look at it on a risk-adjusted basis. So if you're beating the market by 35, 40%, and you're in early stage venture, pretty much your strategy is not working. You need to be at least double. But that type of return over public markets, if you're in mature buyouts, it will okay. That's maybe fine.
I think it's a very valid point. It's all about portfolio construction. Right? So not because I'm doing private equity, hey, it's all in and that's it. You need to look at what are the different strategies, what are the different vintages, building it out over a period of years, right sizing each one on the opportunity set. And then you're looking at, okay, what's my potential return? And if you do it right, number one, over a 5-6 year period of building the portfolio, it self-funds. And you're going to get a 3-4x average return, which creams equities. And forget fixed income. I mean, fixed income's not even on the chart.
We got a question back
Agree.
there in the audience. Yes.
I want to go back to Los Angeles space. A lot of stuff is happening near Los Angeles with space and all the companies that come with it. Can you talk a little about that? You said you were at SpaceX beforehand.
So
Also, can you talk, all of you talk about the pull between private equity and the entrepreneur that you're actually taking on?
So I just want to try to repeat that question. So you were talking about Los Angeles and all that's happening with space, and then the pull between private equity and the entrepreneurs.
Yeah, it's an exciting time to see all these huge 1 million square foot McDonald's, Douglas warehouses now being used by companies. We've tended to focus on companies that are somehow related to information. So we're considering a company that's providing information for agriculture and agribusiness generally, fertilizers, use of water and such. That fits our profile. It's right now the space industry, and it's very exciting, is based more on launches, generic satellite demand. And I've been to many of the companies around Los Angeles, and it's just really fun to see them. Private equity in these businesses probably more in the growth capital stage. Most of the companies bootstrap to a certain point. It's not a leveraged business. All these companies, most all the companies are chewing up equity at ferocious rates. And we even saw that in SpaceX. And we want companies to want more equity and grow. That's our business, but it's not a leveraged buyout business at this time.
And I think this may dovetail into some of the other questions, but the pull with the entrepreneur, this is where I live. Dealing with the founders, when they make the decision that they're going to take the company, they want to take the company to the next level and bring on a partner to do that. So very often with these companies, they're generating revenues that yield EBITDA between, say, for us, between 3 and 10 million. We can go above 10, but that's typically where we play. And when you start to look at companies like that and dive into companies like that, you find gaps. There's gaps in the executive leadership team. Very often the founder, is wearing many different hats. They may have cases where, you got a business doing $5 or $6 million in EBITDA, and the cousin of the founder is a part-time accountant managing it on QuickBooks. So the ability to come in and really professionalize, hold hands with the founder and professionalize the organization is key. Secondly, oftentimes I see companies that are, they're growing 10, 15, 20% a year with no formal business development function, just based off of the reputation of the founder and his or her network. And so for us, I really, really enjoy kind of getting entrenched and building out that function, chief commercial officer, inside sales, field sales, account management. It's the blocking and tackling that comes with the lower middle market, and sort of my role as an operating partner. Once we feel comfortable with the platform, then we'll look to do work with the founder to do add-on acquisitions to get a business into different geographies, different technologies, or diversification of clients. Very often these companies they're very highly client concentrated. So the ability to alleviate that is key for us. But I can't stress enough the partnership we have to have with the owner of the company, the founder of the company. Even though they're keeping a minority stake, with these companies, it comes with culture preservation going forward. That it cannot be an us versus them mentality. And we take many steps to try to alleviate that. But that's so important. The first 90 days of an investment is to get that right.
Yeah. And Mike, can you just speak a little bit? I know that you have a book that's going to target founders and entrepreneurs about what it's like when they come under private equity. Would you just give us a little teaser maybe?
Oh, yeah. This is not meant to be a plug, but it is. I mentioned before I joined Riverside, I spent 20 plus years as an operator with 3 companies, one in urology, one in orthopedics, one in oncology. And every one of those CEO assignments for each one of those companies, some were PE backed, family office backed, venture backed. I never felt I was qualified for those CEO roles, not because of imposter syndrome, but because, for example, I got tapped to run an orthopedics company, and a PE-backed orthopedics company. I didn't know a whole hell of a lot about orthopedics. So what you find yourself is on a very, very steep learning curve, having to articulate very quickly a value proposition to an orthopedic surgeon behind, whether it's financial, patient, or clinical, and to have any sort of credibility. So my process in each one of those assignments was to really very simply think 3 times before I spoke. Listen, and ask a lot of questions, and try to completely immerse myself in these businesses. When I made the transition to private equity, even though I was an advisor to Riverside for almost 5 years, I had PE, venture, family office investors in my companies in the past. It was just as steep of a learning curve for me. And what I employed the same process that I did in my CEO roles, but I did something a little bit differently. I kept a journal, and anytime one of my colleagues or iBanker or an LP used a phrase that I didn't quite understand, or a idiom that I thought was really clever and maybe roll my eyes at because of the absurdity of it, I wrote it down. I wrote down what it was, what it meant, how it was used. And I kept this as a living document over many years. And I've been fortunate to present at colleges and universities on my journey on private equity, entrepreneurship. And I was at Columbia back in 2021, meeting with a business professor there. And he asked me pretty bluntly, nice guy, but how the hell did you ever go from being a PhD chemical engineer to private equity? Why don't you have tenure somewhere at some university teaching chemical engineering? And yeah, exactly. So I shared with him my journey, and I shared with him the journal and how it kind of made a difference for me. And he stopped in his tracks and he said, listen, my students are mired in business and finance texts. They would eat that up. If you could turn that into a manuscript for a book, that would really be compelling. So I pressure checked that with folks in my network, and really positive feedback. And so rounding the corner on 2022, I I shared with my wife for my New Year's resolution, I'm going to put paper to, and well, actually paper to Word document. Long story short, 2 years later, I had a 400-page manuscript. I had head of investor relations at the Carlyle Group write the foreword for me. And the book's being published in a couple of weeks, September 23rd, Dancing Between the Toes of Elephants. I'm now, we're for our founders, for our executive leadership team members at all of our portfolio companies, many investment bankers that we interact with are all going to be kind of using the book. So I'm pretty excited about it. And that's a tool that I think will come in handy for our founders for sure. Yes.
So can I just come back to I'm going to answer your second question, not the one on space, because that's not my kind of thing. On private equity and the entrepreneur, really depends where you're playing in the space. So if you're talking about the relationship with the entrepreneur, that's more VC. Okay. If I'm doing regular private equity, those are more developed companies. They've got EBITDA, the founder is probably a little bit more removed. Okay. So we're conservative that we're not playing in VC. In my prior life, I spent about 15 years in VC world, and it's all about the founder. And the founders are the brainchilds. They're the guys taking the risk with the ideas. They're bootstrapping, to your point, and then they have to bring it to the realization of I need to go out and get funding. And there's different ways. Families and friends doing ABC, and then maybe going to private equity, right? Venture capital funds rather than private equity firms. And now you have a disalignment between the goals. VC wants to make money and return money to their investors, and the founder wants to try and maximize and be in as long as the journey as he can with an exit at some point. And you get that dichotomy of what's the right one and who's my right partner, because no matter who I take the money from, they're more self-interested in getting 2, 3, 4x. So I want to be in for the shortest amount of time possible. But for the investor, if it's me and I'm putting money in as a family and I'm long-term money, right? That's a better solution, I think, for founders. And you want them involved, but you want them to professionalize. And the problem with a lot of founders is they want their buddies around them. They don't professionalize. And that's where they kind of go skew-if and lose focus. And that's the big issue in dealing in that part of the market.
So can you speak a little bit to just due diligence, and then like what you're looking for, what you pass on, or what you take a pass on?
Yeah.
Typically.
So the first thing is we're looking at just the economy generally. So you're going out, meeting the banks, meeting as many people as possible, trying to form a view. If everyone has the same view, like the warning lights go on and it's like, why does everyone have the exact same view? Not healthy. Once you've formed your view, then you're going out and saying, okay, who plays in that space? And then you're sitting down with the managers and trying to understand, so how are you attacking that space? So I'll give you a perfect example. I've done this the last 3-4 weeks. I've spoken to 9 different funds in the sports media focused arena. Okay. And I'll name the guys just so you all know. TPG, Avenue Capital, 6th Street, Clear Lake, Arctos, Bluestone, Dynasty are the key guys we've been speaking to. Each one tackling it in a completely different manner. Each one is a different size fund. Avenue's $3 billion, 6th Street is $600 million. One is taking minority stakes in the actual teams in the big leagues. The other ones are doing emerging sports groups like WNBA and women's soccer and esports. Some are just doing it through media, so adjacent to sports. So then it's a matter of, okay, which one fits us best? And it's what fits us. It's not that they're not good. It's what fits our investment thesis, what we're looking for, and going on what Gary said on the risk-adjusted basis, that makes sense for us as an investor. It's very personal.
I've been asked by companies, what is your due diligence process and how long does it take? And so I now rather cheekily response, oh, it's anywhere from 2 hours to infinity. And because actually our best multiple and dollar investment was Ripple Labs. And we decided in 2 hours on a President's Day weekend, and I got approval of the investment committee to go ahead. So, but what did I have? We actually invested in that fund. I knew the company. I'd been following the company, and the data set that was presented to me by the holder that was selling was compelling And of course, I checked it out with my wife. I said, darling, do you ever have problems with international transfers of money? She said, every day, 10% are failures. So what we're looking for is different than, let's say, a family office trying to make an investment in a single company, because we have syndicates and we have relationships with other investors who maybe have done more work than we have. And we only exist with our staff on the basis of building a community where we can share information. So that often makes due diligence go much, much quicker. And sometimes, though, it's different. In SpaceX, we had an inside track in a sense. We were invited to have a visit, and we brought 6 families with us, and the tour was guided by the CFO. And we learned that Starlink was actually going to be the engine to fund the rest of the company. And they had 3 satellites up, maybe none. We said, we like that. So the question was, what's the market cap of Verizon? It was 300 million. We were investing in low 20s. I said, this is a better company. Let's invest in SpaceX. We don't care about the launch business. It will go on. It's downside protection. But that was our due diligence, was sometimes special insight that other people wouldn't get. And Starlink and SpaceX were not known for that at all.
But Gary, keep in mind, you're looking at individual firms. We're going to the private equity firm, so we get more diversification. So it's also a different approach, right?
Totally correct.
Yeah, what about you?
You know, for us, third real issues, you know, we look at 300 opportunities a year in healthcare, and maybe in a good year, we'll make 2 or 3 platform investments. We'll do all sorts of add-ons for our portfolio, but you know, I come back to the founder, making sure we're aligned there. But you know, if it's a fragmented space with not a lot of room for consolidation, that's an issue. If there's you know, limited TAM or you know, price erosion in the market, or customer attrition, if we're looking at we scrub. These are smaller companies, right? I mean, we can scrub the majority of customers and think about where they are in the life cycle of the business, and have to feel really good about that too. So.
Excellent. So are there any areas where you are investing in right now, or areas that you see are really popping or a little bit different? I heard the mention of the WNBA. Yeah.
So we're not doing WNBA directly. Again, that's through a sports fund.
Oh.
But what the family is doing directly, we've got a couple of things that we're looking at. So I would say the majority of the assets are in real estate in the Sun Belt, but we've been diversifying. We've got some stuff in the UK. We're doing some stuff in Europe. We've got a very big project in Europe. And I've heard this a couple of times. One thing we're looking at is data centers as well. That's the AI focus. AI infrastructure in some format has been of great interest. Other than that, when we look at the general liquid portfolio, wherever there's opportunity. And so that would be where we'd look at a sports fund, or we just looked yesterday. It's a very interesting on SRTs. So it's a form of debt instrument where you're getting 14% unlevered. That's really interesting. And that was brought to us by Blackstone. So we're talking to people constantly, looking for innovative and different ideas that's going to, again, going back to what Gary said, make sure we're putting things in the portfolio that give us diversification, non-correlation, and is going to reduce our overall risk.
Yeah. Anything to add from my other panelists there? Areas? No.
We're looking along the lines of our thematic of let's use information to do things better. They brings us to what could be called vertical software. But we don't see ourselves as software investors. We're solutions, and let's do something new and better investors. Artificial intelligence is like too big to ignore, and it's kind of always out there. What's going to happen? How do we get in it? I know a billionaire crying that he missed artificial intelligence. He said that we're just on the ground floor, really. So that's always out there, and other companies that can streamline operations, redefine supply chain, and companies doing things like that, as compared to, we can't do deep science. We just don't have the expertise, biotech, therapeutics, and such. And we do have this special eye open for space in the notion of what companies out there are going to provide information to run businesses better that you can see from space. Like I mentioned before, agribusiness. And so we're looking closely at those kinds of things.
Interesting. So I just wanted to open up to the audience for a second, see if we have any more questions. Oh, yes. Yes, you can. Do you need There you go.
This is for everybody, but Gary, I think I mentioned earlier, the panel was on the VC panel. We have the good fortune to represent SpaceX and OpenAI and their intellectual property. And with work I did for the government, I had the chance to visit SpaceX, and it's actually not a huge facility. It's a pretty amazing experience to go out there in LA. So my question is, they have not gone through an IPO for all three of you. We discussed the how kind of rough the IPO market, or people aren't using that route. What do you see for them? Maybe I'm not asking for inside information, but just the IPO market for SpaceX and others.
Here's change in the fundamental environment is the growth of secondary markets. Let's say 10, 15 years ago, there was nothing happening on the secondary markets, dominated by people of Fidelity with hugely complicated instruments. Unless you were an official at the company, you couldn't figure out what they were doing. So that evolved over time as companies realized, look, if they had an all common or a light preference stack, there could be sales of their shares. And what that meant is that they could delay going public later. SpaceX is a good, a prime indication, but now there's at least 100 names you can sell in a couple of days. And I think that's the change. And there's also the inbred headache of being a public company. And there's so much private money available. Well, why bother? And so that's a change in the environment. But as far as us from private investors, we can sell and we can buy too. And so we're looking at being buyers in the secondary market at discounts to what we think companies are worth. I'm sorry, did that answer your question or answer some other question that you didn't ask?
Because I've heard about that through the investor meetings that I attend and I host. And my understanding was that SpaceX may have limited the rights for secondaries where they wanted first rights to acquire. I don't know if that was accurate or not. So, but that's what I heard.
I mean, right of first refusal
Yeah.
on shares.
So.
They're pretty freely traded. It depends what you're in. If you're in an SPV and you're trading a position in that SPV, which is on the cap table, they don't have any say on it. So they have to be, it has to be somebody on the cap table, somebody they can control. And if it's an SPV, which so many SpaceX shares are held, that they don't have a say in that.
Yeah. So if I can tackle this maybe
About 5 minutes.
So SpaceX has a gray market. So everyone now has excess, even if it's not quoted. And I agree. Why the hell do I need to have the headache of dealing with the regulator? And Elon Musk is not exactly the guy who's had the best reputation with the SEC. So if I can keep it gray market and do whatever the heck I want without having them with a knife to my throat, I'll do that. And if that's going to be better for the investor, then heck, I'll take that all day. You don't have to go the IPO route. And number two, maybe you find a strategic buyer or a merger. It doesn't have to be IPO. There are other ways to skin a cat.
Well, SpaceX, just very quickly,
I just want to clarify something before we go on. But when you the difference between a merger and an IPO, mergers typically are about 25% of the value of an IPO, historically speaking. So when you acquire a company, they're realizing 75% less than in an IPO.
It depends how it's structured and how the payout is. And again, depends on the payout structure.
Almost
It's
equals
not-
up. I mean,
no, but again, you don't have to go IPO, and it can be private to private. So again, IPO isn't the only route for exit.
you're right, but it's duration based too. IRR calculation, right? Thought.
SpaceX on the defense side probably shouldn't go public. They might be forced to disclose a lot more. I think the telecom, then they want to. The telecom business would be a great IPO, and eventually that may happen.
Excellent. So any closing thoughts?
I was
Mike?
just going to say one, maybe as a closing thought, but Peter, on the coming at it from a totally different sector, biotech and pharma, what we're seeing on the VC side today is almost like what I've seen the last 4 or 5 years on the PE side with continuation funds and secondaries. Just this week, Atlas Venture announced a $400 million opportunity fund to put money back into their existing portfolio, because there's some green shoots now with the IPO market for biotech that we're hoping catch. But that's an interesting dynamic that we're seeing across the venture community.
Excellent. So I think I have an audience question here.
I didn't mean to interrupt the closing remarks because
No,
they're
that's
interesting. Great panel, by the way. Where are you finding most of your deal flow, and where would you want to find more of it?
You guys. Question that's asked a lot. It's fundamentally personal relationships across our community. Could be other funds, could be family offices. And while it's, yeah, we're going to go out and play golf today, it's more than that. Is based upon those personal relationships, you need a system of when are you going to visit this company? When are you going to see this person? When are you going to see it? So that consistently you're in the flow. One thing we've done recently is we've talked to some of the funds we invested in at the seed stage and say, hey, what's interesting in your portfolio? And then go visit and say, hey, we're your next round people. By the way, can we help you with an introduction now? So that's one of the ways that we get in. We just build a relationship and just try to be friendly, and people appreciate, and they can always call us for ideas. And that's kind of in a nutshell. It's relationships with a system.
We see deals every week from investment bankers, right? It's just that trying to go ahead and network. I do a lot in deal origination. This one company that we have in the pharma services space, Synergy Biopharma Group, I met one of the founders. I was giving a talk at Babson College, and he happened to be a student. And so, sometimes it takes, they're actionable very quickly. Other times it's a relationship that you have to build to make them feel comfortable, and take, 3-4 years at times.
Yeah. Any closing thoughts from my panelists?
Sammy?
Sammy?
I'll kick it off. So I would say for the family offices out there, don't have FOMO. So this business of, oh, I'm missing the AI, nobody's missing the AI, because if you've got Google and you've got the Magnificent Seven, somehow you've got access to AI, right? So everyone has AI through some other investment they have that's doing in the AI space. So don't go for FOMO, because you're going to probably mess up and buy the wrong thing. So that's one. I agree. I think the networks and conversations, keep in mind, family offices like the one I'm working in, we've got 3 professionals looking over the assets. We've got a limited amount of bandwidth. We get bothered all the time by people trying to sell their wares. And nobody asks, what do we want? They just want to try and come and tell us, this is what you should buy. It's like, I don't care what you have to sell. It's what I'm looking for that's important, because I have limited bandwidth. So, keep that in mind when talking to family offices.
Closing comment 2.0. With AI, what we're seeing across the pharma and biotech space is just incredible. From molecule discovery, making it tremendously more efficient, to clinical trial design, biosimulation type work, dosing studies to accelerate time to approval. In every one of our portfolio companies, we ask ourselves, is AI a friend or foe, and when? And to just try to, not stick your head in the sand, but to really embrace it. And so much so, we had an AI summit that I organized late last year, bringing in all of our chief technical officers in for a day to talk about a SWOT analysis for each one of their companies on where they are with AI. Not only was it just great for the crosstalk and the networking, but it really kind of gave these companies and leaders a fresh perspective that they weren't sitting on an island thinking about AI at their companies. So it was really beneficial.
All right, Gary, final word here before Marty kicks us
Well,
off
I'll
the
agree
stage.
with something we don't even do, which is this is the age of biology, and there's going to be tremendous innovations in that space. I'm supporting you. Also recognize that we don't know how to do that. So we're not going to do it, but if you can find a good way to get into that, that was something I recommend. We have a great combination of money, experience management, and a irrepressible desire in this country and others to innovate. That's a good recipe for us in exciting times.
Excellent. I just want to thank my panelists. Thank you so much. It's been really interesting. If anyone has any more questions, just find